Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, March the 16th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Quite a bit of economic data coming out today. We had final CPI for Europe come in line with expectations at 2%, was expected to be 2%. Core CPI came in at 0.9%, was expected to be 0.9%. Then we also got the Great Britain bank rate right in line with expectations, 0.25 or 25 basis points, so they didn't move anything there. And then here in the United States, we got building permits, a little bit lower than expected at 1.21 million, was expected to be 1.25 million, and Philly Fed manufacturing came in higher than expected at 32.8, was expected to be 30.2. So we're seeing all of these manufacturing numbers come out better than expected. Unemployment claims came in at 241,000, slightly lower than the expected 245,000. Housing starts came in a little higher than expected at 1.29 million units, expected to be 1.26 million units. And JOLTS job openings a little bit higher than expected at 5.63 million, expected to be 5.43 million. So higher than expected there is good. That means people are hiring. And then we got natural gas storages as a drawdown of 53 billion cubic feet versus the expected 60 billion cubic feet. So all in all, pretty decent economic data across the board. Overall, equity markets are down, but we'll get to that in a minute. We can see here that crude oil futures are down on the day. I've talked about this several times. Anytime you get these opposing dojis where it looks like it could be a top, but we've got a nice bottom here, and then this doji here today with the market looking like it's going to be down for the most part. But anytime you get those opposing, could be a continuation pattern and see it come up and try and test this Fibonacci level. Eventually, I think what we're going to see is a little bit of move like that and then back down to test the point of control. There's just still a lot of oil out there, despite the fact that we did see a drawdown in the inventories number last time. I still think that there's a plethora of oil out there, and we could continue to see this kind of wane a little bit, especially with the ramping up of the fracking and all the oil rigs and everything else kind of ramping up here in the United States. So I think we're going to continue to see builds in oil without the demand really necessarily. Then we've got bonds down right now, about 21 ticks on the day, not quite a point, but giving up most of yesterday's gain. It was a really weird day yesterday. We had a massive rally in the equities with the bonds rallying as well, and gold. Everything would seem to be up. I mean, nobody probably was complaining other than me for being the markets across the board up on the day. Then we got the Dow Jones Industrial Average here, just off by about 4 points, and nothing really to be concerned about here. The overall market had gotten back above that 9-day moving average finally yesterday, settled above there, giving a little bit more oomph to the upside, but the overall market's just kind of taking a pause as after yesterday's big rally. NASDAQ is off on the day by about 3 points. Now, we did make a new historical high, but one thing to consider with that historical high being a bear, that was printed in the overnight session. As you can see right here at midnight, basically, the overnight high, midnight here, which would be like 3 o'clock in the morning, East Coast time. We printed that high. So the overall market is going to want to try and capture that within the day frame, despite the fact that if we were to look at this on a daily chart, it looks rather bearish or like a top, because we have this doji up there. That just, normally if you're just looking at it for face value, that does look pretty bearish, but I'm under the assumption it's going to have to get printed sooner or later, and it may be the sooner that gets printed. E-mini S&Ps up on the day, down on the day now by 1.25. All intents and purposes, pretty much unchanged right where we were yesterday. After that big rally, we'll see the rally here on this chart. This is the 30-minute breakdown of the E-mini S&Ps on a 10-day chart. And as you can see, yesterday afternoon, the market just blew off to the upside. Again, we do have this print overnight of the high there, but it's not a historical high, which is a bigger issue for the NASDAQ. The NASDAQ is going to want that historical high printed in the day session. They do not want to lose that to the overnight session. I just can't see that happening. So we're going to have to be touch and go on that one there. Then on to the trades that I've done. This is American Airlines. Yesterday, or if you guys remember, I was trying to get out of this for a couple of days now, and I had on the May 40-50 put spread. So long the 50 puts, short the 40 puts, came down there and tested it yesterday. Was really, I probably got a little too aggressive with that. I thought the overall market was really going to kind of go a little bit further. Stopped, did a reverse. It participated in that rally, probably one of the major reasons for that rally. But anyway, ended up chasing that. I originally paid for that strategy just under $5. I paid $4.95 for it. So my target on that trade was $7.50. Probably could have done that had I pulled the trigger early on in the day, but worked that order. Finally, when it started really blasting off, I decided to pull the ripcord on it and got out for $6.90. So not quite the 50% of my max profit potential on that. But with that big rally going on yesterday, I decided to pull the ripcord on it. It just kind of went down there, beat the probabilities, wasn't quick enough to the punch, and decided to pull the ripcord on it late in the day. Then, or in the afternoon, I should say anyway. So this is a trade that I put on today. Came up and Halliburton, ticker symbol HAL, came up and tested this value area high. Now we've kind of printed into there, and I was thinking, I missed the trade when it came down, went through that 200-day moving average. So it's kind of been on my radar. Yesterday participated on that rally, but kind of fell short of getting outside of the value area. So it could easily start to roll over. So I decided to put on a small trade in here with Halliburton. And the reason why, very low implied volatility. I'm doing a put spread on it, not a whole lot of time before we get to the earnings cycle. So I like to put these put spreads on a little bit longer duration because, you kind of get the same bang for your buck. Went back and forth with it, and it just kind of seemed to work out a little bit better by going into the April, and did the April 47.55 put spread in there, and paid just under $2 for that trade, which is it's a $8 wide spreads, 47.55, so just under $4. Excuse me for that, and paid $3.71 for that trade. So looking for it to come down and come back down into the value area and test this 200-day moving average again, because my 47 puts are down here a little bit, but I'd like to see it come back down and at least test that. If it gets that far and rather quickly, I should be able to achieve 50% of my max profit on that. So it's $8 wide, paid $4 for it, let's say, just for rounding purposes. If I can get out for $6, that's where I'm going to look to exit that strategy. That's all I got for you guys today, other than tomorrow's webinar is going to be on a ratio put spread. I'm going to show you how to take a long put spread, add a little bit of risk to it, and we will have no upside risk to that, but we are increasing our risk to the downside. So I'm going to show you how to build that strategy out and increase your probabilities of success with that, hopefully. All right? So that's all I got for you guys today. Other than if you can't take that, take it easy.